Hello and welcome to Indianomics. The Independence Day weekend has been momentous for the Indian economy. Eventful, perhaps, is a more correct word. On Thursday, even before the weekend started, S&P upgraded India to BBB, one notch higher than investment grade, the best grade we've got so far. On Friday, the next day, that is, the Prime Minister announced that GST rates would be cut by Diwali. And over Sunday, our reporters were picking up that the US-India trade talks next week are postponed, which means the dreaded 50% US tariffs may happen after all, albeit for a short time. What does all this mean for the economy, for bonds, and for the cost of capital for companies, for their appetite to invest? I have with me ace banker and bond expert Neeraj, Gambhir, Group Executive and Head Treasury Markets and Wholesale Banking at Axis. We have also got economist Sonal Varma, the Managing Director, Chief Economist at Nomura. We have Kanika Pasricha, the Chief Economist from Union Bank, and Narang, the economist from ICICI Bank. Ladies and gentlemen, thank you very much indeed for your time. Well, first, let me get the macro picture, then we'll get to the bond picture. Sonal, the rating upgrade and the GST cut consumption boost. One is a Capex boost because it brings down the cost of capital. One is a consumption boost. Are you changing your macro growth numbers?
No changes as of now, Latha. I think there are lots of moving parts. The rating upgrade, of course, is an acknowledgement of what's been going right in India. So it's a sentiment booster, might lower the cost of capital for some companies. But in terms of a substantial change in capital flows, etc., I think there are other factors that are offsetting that. The most important being the US-India trade talks and the likelihood that the higher tariff rates are likely to stay for a while. So the impact of that on exports and investment is something which we will see September, October onwards. The GST is a positive surprise. I think typically what we've seen in the past when such tax cuts are announced is that consumers postpone their consumption decisions in anticipation of lower prices. So we could see a softer patch in terms of durable consumption in the run-up to Diwali and a bigger boost after that. So on net, lots of moving parts. As of now, we are still at 6.2% for FY26, and risk we still see skewed to the downside.
Okay. Kanika, your views? Overall, there is a negative from the tariffs probably for some time, but a positive in terms of consumption boost. Where do you stand in terms of growth?
So, Latha, I completely agree with what Sonal said. There are a lot of moving parts, which is why we never changed our growth forecast as well. We maintained it at 6.3% from the start of the fiscal year.
Okay.
While 30 basis points is a direct estimate impact of that 25% tariff hike, we would also want to await the GST booster shot coming in the form of consumption once the taxes kick in from Diwali. But yes, details awaited A, and B, on tariff talks also, whether any penalties are imposed, because there are also news that the US authorities are not coming to India. That needs to be closely watched. So yes, moving parts, but I would just want to add one thing, maybe from growth perspective, there is a sentiment hit of these tariffs. So maybe the growth impact is delayed from these positive stimulus measures, but direct inflation impact may kick in from December quarter itself. It should be a positive to watch. Thanks.
Fair enough, of course. Samir, your thoughts? I mean, people were talking about a 0.6% or 0.4% GDP impact, even when it was 25 basis points, the tariff hike. Now, 50 at least for some time is a possibility. So what, do you leave your growth numbers unchanged?
No, I think, Latha, when we started the year, we had downgraded the growth estimates because of weak growth outlook. Then we upgraded after the front loading of monetary policy. And post the incremental tariffs, now we stand at 6.3%. We've lowered them a tad bit by 10 basis points again. Now, both these events of higher tariffs, as you correctly mentioned, the overall hit of 50% tariff for part of the year will be lower. For a 12-month rolling basis, of course, the number that you mentioned will be on the higher side, maybe 0.7, 0.8%. But there are a lot of mitigants, as we see. And one of them is the GST announcement that has happened. That is one. And the second thing is that, even in case of China, where tariffs have been very high, re-exports have happened from other geographies. So it is very likely that in India's case, at least for the larger set of producers which are part of the supply chain, be it for gems and jewelry and even for textiles, there could be re-exports happening from other geographies.
Okay.
But for MSMEs, the impact would be larger. So on an overall basis, our sense is that the optical hit looks much higher. The eventual effective hit will be perhaps half of it. So our number is around 0.4% of GDP.
Okay. Well, the point is it may not be very growth positive considering so many factors may cancel out one another. But it's certainly a stock market positive because the GST and the income tax cuts are going to be EPS accretive for sure. And most important will be the cost of capital. To you, Neeraj, are you expecting we already saw a steep fall, a good, 7-8 basis points fall in bond yields on Thursday itself because bond markets could still take advantage. But today the yields have gone up from Thursday lows because of a feared fiscal impact. So net, do you think cost of capital goes down for companies?
Sentiment-wise, it's very positive. I think the S&P rating upgrade was a bit of a surprise. I don't think anybody in the market was expecting for it to happen now. If anything, there were expectations maybe next year we could see a rating upgrade. But the fact that it has happened now is obviously a positive for the sentiment in all the markets. The impact on flows will be a bit muted at this point in time, given the other macro variables, particularly on the trade side, has been mentioned earlier, they play out. Bond markets, I think for now, have taken about 5 basis point net gain over yesterday and today, or the previous business day and today. I don't think we materially change from here unless and until some of the other things play out. The tariffs, playing out will have a bearing on the currency, which eventually will have a bearing on the flows. And therefore, I think that market will wait for some of these issues to be sorted out before, changing the direction.
Okay. But what about, your own sector, Neeraj, along with the sovereign rating being raised, all financial institutions' ratings are also raised, those that have a global rating, like State Bank, etc. The rating has already been raised. Likewise, we already hear that a lot of NBFCs are beginning to raise global capital since it becomes a tad cheaper. Can we say that the financial sector as a whole is likely to get slightly cheaper capital than we expected, say, up until Wednesday?
So not everybody in the financial sector is borrowing externally. Some of the public sector banks borrow externally to fund their offshore locations. And we have seen about 10 to 15 basis point tightening of the spreads in the dollar bond market since the rating news has been announced. As more and more of Indian companies, including the NBFCs, tap the overseas market, given the fact that we now have a BBB rating, will certainly help them raise higher amount of funding at a slightly tighter pricing. So yes, net, to the extent that financial sector is borrowing from external world, there will be some benefit in terms of pricing.
Yeah, actually, in our zest, we are forgetting, look at the way the financial stocks have moved today. This morning, Bajaj Finance, Sundaram Finance, Chola, M&M Financial, Shriram Finance, all of them up between 3 and 6%. So clearly they see a cheaper cost of capital coming their way. Will that, PFC, REC, I think will be the biggest beneficiaries because they are always borrowing abroad. You don't see any Capex impact of this, Neeraj?
I don't think rating per se impacts Capex. Rating, as I mentioned earlier, that improves the sentiment.
Okay.
It makes it easier for the financial institutions to lend to the companies in a country, particularly the external world. But I think Capex has several other dimensions to them. And I think at this point in time, the tariff-related uncertainties are the bigger play. And once they are sorted out, only then I think the Capex cycle can have some positive impact.
Okay. Let me toss that to the economists. Sonal, what's the sense? there is this expected consumption boost, especially cement. I mean, it's been at 28%, and there is a very good chance it's going to come down to 18%. Likewise, small cars, two-wheelers, very clearly those are... would that trigger a capex boom as well, considering that the cost of capital is going to fall? Not boom. Boom is a strong word, but it trigger capex.
I mean, I think in the overall scheme of things, Latha, right now, first and foremost, we need to see certainty on demand, both in terms of consumption demand certainty going forward and visibility on external demand before that triggers any capex boom. What the GST cut does is it will bring down the price of items that are considered more essentials in nature. And so to that extent, there could be some boost at the margin to consumption demand. Although, as I mentioned, most of this will come after Diwali. We could see some moderation ahead of Diwali. The more fundamental drivers of consumption ultimately will be the ones to watch, what's happening on job creation, how are wages and salaries moving. Lowering prices is one of the factors that drives consumption, but of course not the only one. Similarly, on the exports, things look like we are going to see a moderation in our exports to the US. So I think it will take a bit of time for us to basically say that Capex revival is here.
Okay. Actually, I forgot to ask you all the other big question, economists. What about the fisc? Sonal, would you think that what S&P is giving us in one hand, we may be losing by increasing the fiscal deficit?
We don't know, Latha. I think everyone's jumped to the conclusion that this is a massively fiscal expansion, but we don't know exactly what the fiscal impact will be. While bulk of the items are moving to the lower tax slab, what the revenue share is, so not the volume, but the revenue share of those items is also important because states will not want to lose any revenue from any GST rationalization. So if we are moving more items into the lower tax bracket, but some big revenue contributors to the higher tax slab, the net fiscal impact actually may not be as negative as is being feared. It will still lead to disinflation because the share of these essentials is a bigger share of the overall CPI basket, but it may not be as negative on fiscal is our sense.
Okay, but the market, probably the bond yields have moved up out of fear that there can be some kind of fiscal impact as well. But there are more questions. There was an expectation that the fiscal room available, elbow room available because of the big RBI dividend could be used for a package for the exporters who are reeling under that 50% tariff. Maybe it will be for 3 months, maybe for 6 months, but that handholding is needed. Will that package come? All those questions to my guests after a break. For Bazaar viewers, you can see the rest of the show at the end of the trading day. But we continue with our conversation after the break.